Imagine a company so powerful, so admired, and so influential that it was named America's Most Innovative Company 6 years in a row by Fortune magazine. A company praised as the future of business, the perfect marriage between technology, finance, and capitalism. A company that promised to reinvent not just energy, but Wall Street itself. Now imagine that same company collapsing almost overnight, exposed as one of the largest corporate frauds in history. Executives disgraced, employees ruined, billions of dollars erased. This is the story of Enron. In the early 1980s, Enron didn't look special at all. In fact, it barely stood out. The company was officially created in 1985 through a merger between two traditional natural gas pipeline companies, Houston Natural Gas and Internorth. At its core, Enron did one very simple thing. It transported natural gas from producers to utilities. That's it. No flashy technology, no cutting-edge innovation, just pipelines. It was a stable business, but also a boring one. And in a world increasingly obsessed with rapid expansion and Wall Street excitement, boring wasn't good enough. But everything changed when Enron's founder and CEO, Kenneth had a much bigger vision. Kenneth didn't want Enron to be just another energy company. He believed that energy markets were about to change forever. Envisioned Enron not as a pipeline owner, but as a trading powerhouse. His idea was simple, but revolutionary at the time. What if energy could be traded like stocks? Instead of making money by owning physical assets like pipelines and power plants, Enron would act as a market maker, buying and selling energy contracts, matching buyers and sellers, and profiting from the spread. It was a bold shift, and it worked. Soon, Enron wasn't just trading natural gas, it was trading electricity, then bandwidth, then commodities, then derivatives based on weather patterns, even water. If something could be priced, Enron wanted to trade it. But to turn this vision into reality, Enron needed a new kind of leadership, and that's when Jeffrey Skilling entered the picture. Jeffrey Skilling was everything Wall Street admired. Brilliant, aggressive, hyper-competitive. A former McKinsey consultant, Skilling believed Enron wasn't really an energy company at all. In his mind, Enron's real product was financial innovation. Energy was just the excuse. One of Skilling's most important and dangerous changes involved accounting. Traditionally, companies record profits when they actually receive cash. But Skilling pushed Enron to adopt a method known as mark-to-market accounting. Here's how it worked. The moment Enron signed a long-term contract, maybe a 10-year agreement to supply electricity, the company would estimate how much profit that contract would generate over its entire lifetime. Then it would record all of that profit immediately, not over 10 years, not as cash came in, immediately. Even if the money wouldn't arrive for years or might never arrive at all. And if those profit estimates turned out to be wrong, they could always revise the assumptions, adjust the models, tweak the numbers. On paper, Enron became a profit-generating machine. Quarter after quarter, earnings appeared strong. Growth looked unstoppable. Wall Street was impressed. As Enron's reported profits skyrocketed, its internal culture transformed. This was no longer a traditional company, it was a pressure cooker. Employees were constantly evaluated under a brutal system known as rank and yank. Every year, managers were required to rank their employees from best to worst. The top performers were rewarded with bonuses, promotions, and stock options. The bottom performers, usually the bottom 15%, were fired, no exceptions. Even if the team performed well overall, someone still had to go. This system created an atmosphere of fear and extreme competition. Employees were encouraged to take massive risks, push deals through at any cost, and never, ever admit failure, because admitting failure could end your career. Integrity took a back seat to results, and results were measured almost entirely by short-term numbers. Behind the scenes, however, those numbers were starting to crack. Many of Enron's big bets simply weren't working. International energy projects lost millions. Some investments failed completely. Others never produced the returns that had been promised. Under normal circumstances, a company would report losses, but Enron couldn't. Its entire reputation and stock price depended on the illusion of constant growth. So instead of admitting failure, they hid it. This is where Andrew Fastow enters the story. Fastow designed an incredibly complex web of off-the-books partnerships known as Special Purpose Entities, or SPEs. On paper, these entities were supposed to be independent companies. In reality, they were controlled by Enron, and sometimes, unbelievably, by Fastow himself. Here's how the scheme worked. When Enron had a bad investment or a loss, it would move that loss into one of these SPEs. Debt disappeared from Enron's balance sheet. Losses vanished. Meanwhile, Enron would guarantee the SPEs using its own stock, meaning the entire system depended on Enron's share price staying high. It was financial engineering built on sand. Even worse, Fastow personally earned millions of dollars managing some of these entities. It was a massive conflict of interest, completely unethical, and yet it was approved because Enron's leadership didn't want to ask hard questions. As long as the stock kept rising, no one wanted to know the truth. Wall Street loved Enron. Analysts praised it as the most sophisticated company in America. Business schools taught Enron case studies. Investors couldn't get enough. Enron's stock price climbed from under $20 to over $90. Inside the company, executives quietly sold their shares, while publicly encouraging employees and investors to buy more. Many employees invested their retirement savings almost entirely in Enron stock. They trusted the company they worked for. They believed the story. They believed the hype. Then, in 2001, the illusion began to crack. Journalists started asking uncomfortable questions. Financial analysts noticed something strange. Enron's profits looked incredible, but its cash flow didn't match. The financial statements were incredibly complex. Too complex. In August 2001, Jeffrey Skilling suddenly resigned as CEO, citing personal reasons. The market was shocked. Soon, Enron announced massive write-downs and admitted that some of its partnerships had been hiding debt. Confidence evaporated almost instantly. Credit rating agencies downgraded Enron's debt. Trading partners pulled away. The stock price collapsed. Within weeks, Enron went from Wall Street darling to corporate disaster. In December 2001, Enron filed for bankruptcy. At the time, it was the largest bankruptcy in U.S. history. The aftermath was devastating. More than 20,000 employees lost their jobs. Many lost their life savings. Investors lost billions of dollars. Arthur Andersen, one of the world's largest accounting firms and Enron's auditor, was destroyed after being found guilty of obstructing justice by shredding documents related to Enron's audits. Executives faced consequences. Andrew Fastow went to prison. Jeffrey Skilling was convicted of fraud and insider trading. Kenneth died before sentencing. The Enron scandal reshaped corporate America. It led directly to stricter regulations, including the Sarbanes-Oxley Act, which increased accountability for executives, auditors, and public companies. But Enron's story isn't just about accounting tricks or greedy executives. It's about what happens when growth matters more than truth, image matters more than reality, and success becomes more important than integrity. Enron didn't collapse because of one bad decision. It collapsed because an entire system rewarded deception, until the truth finally caught up. And that's the story of Enron, a company that tried to trade everything except honesty.